In this week's video, we'll answer the question, is a stealth bear market already underway? Last week we talked about price being relevant even in a low conviction market. What do we mean by that? In short, the major indices have to unequivocally break down before either A, we can move into a correction, or B, morph into a bear market. That calls for some patience when we review some of the charts this week. The charts that have cracks or somewhat of a stealthy look, one of two things can happen. The cracks can be repaired or they can widen. It's not safe to assume that they can only widen. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a screenshot of the CCM market model. The market model is described in more detail at the end of the video. Regular viewers know that we use the market model to help us answer the question, what is a prudent exposure based upon the market's current profile between risk assets such as stocks and conservative assets such as bonds? The answer to that question, when we compare the present day profile to past profiles a week ago, was a 64-36 split between risk and conservative assets. This week, it's a little bit lower, but very similar at 58-42. If you're an established client and you review your account, you should be within striking distance of either one of these numbers. In terms of the rules that we have, we want to balance being firm relative to what the model is telling us with trading frequency. The rules allow us a little bit more leeway in terms of how closely we pin to these numbers when you have a flat 50-day moving average and an indecisive market profile. The more decisive the market profile, the less leeway that we have from week to week in terms of managing against these numbers. When we see more conviction one way or another, the rules will force us to manage more closely. We'll start with three charts tracked by the market model. This is the credit market's junk bonds, riskier, higher yielding bonds, relative to more conservative treasuries. You can think of this as risk on versus risk off. This is what risk off looks like. Similar situation here. This is risk on relative to risk off stocks versus bonds. We'll explain this once and then use this concept on almost every chart that follows. These are weekly charts. We use the moving averages to help us discern between volatility to ignore and volatility to respect. A full bore bullish look is when the ratio or price is above both moving averages, blue and red, and blue is above red and the slopes of both are up. It tells us that the probability of good things happening relative to this ratio are higher when it looks like this. The probability of bad things happening increases when we get a full bore bearish look. Price below blue and red, blue below red, and the slopes are down. So you can see the credit markets have a full bore bearish look currently, and we have a clearly defined downtrend on the weekly chart. This is a stealthy problem look. Small caps, full bore bearish look on the weekly chart, and now we are testing this area of support that we talked about in past videos. We're already below this area and below this area. Now we're testing this area here. This is a chart that the bulls would prefer to look more like this. Would I rather be in stocks or would I rather be in bonds? Has a full bore bearish look in favor of treasury bonds, but you can also see it's still relatively indecisive with no clear winner over the past few months. Experience tells us that we should monitor the market's profile and adjust as necessary rather than anticipating what will happen next and hoping that our anticipation is confirmed by the market. If this doesn't make much sense to you, you can Google the Shavako Capital channel. There's a video from September 22nd titled, "Where is the stock market headed?" At the 236 mark, it talks about how really ridiculous it is to try to forecast where the stock market is going by making an analogy to handicapping football games. You can understand what we're referring to relative to the stealth concept here. We've got risk on versus risk off, stocks versus a diversified basket of bonds, stocks versus intermediate term treasuries. This is a indecisive look. It's not full bore bearish, but it's leaning bearish in the short run. Similar situation here, but we do have blue below red. So both of these charts are throwing up some yellow caution flags right now, but you can see they've been very, very indecisive recently in terms of months. Why do we call it a stealth issue? Well, you can see here the major indices, such as the Dow, this is a full bore bullish look. The major indices, for the most part, have not broken down yet. The Dow, and we own industrial stocks, is holding this breakout above 16,478. If we were to move in this direction, and this chart would have looked more like this period here, our concerns would increase. But right now, price looks pretty good on the Dow. The market model literally looks at thousands of pieces of data each week and each day to come up with a prudent allocation. You may ask, if you're a client, you keep showing us concerning charts, well, why do we still have exposure to stocks? Well, here's a chart, long versus short, that still has a full bore bullish look. It is mathematically impossible to go into a correction or bear market with a look like this. We need to see something change here. If it does, then the market model will begin to check more bearish boxes. The VIX relative to the S&P, so risk on versus risk off, S&P divided by the VIX, also has a full bore bullish look in favor of stocks. However, you can see resistance here. The stock market eventually dropped. Resistance here, stocks eventually dropped. So we'll be watching this next week. Breadth, which is also tracked by the market model, is concerning. This is telling us that fewer and fewer stocks have been participating in the advance since early March. We'd prefer to see this chart look more like this if we're a stock bull. This is the weekly chart of the S&P 500 tracked by the market model. This is a zoomed in look here. You can see we still have a full bore bullish look favoring stocks. However, this breakout here at 1878, we closed just below it this week. We also have been moving sideways on this ratio here for quite some time. So we're looking for a more definitive break either up or down, but right now this still looks pretty good. If you want to learn more about what the stealth bear market looks like, you can Google this here. Friday's post on Short Takes or on Seeking Alpha covers this chart, 2008 before the 42% drop in the S&P 500, and then it shows you the observable evidence at the low in 2009, and then we compare those two charts to what the present day chart is telling us. Regular viewers know that the market model tracks observable evidence. This is the weekly chart of the S&P 500. We're looking at momentum. When we have momentum in overbought territory, the probability of good things happening increases. And when it drops out of overbought territory on a closing and observable basis, after that, the probability of bad things happening increases. You can see this week we did just barely drop out. You can also see the conviction here is much, much lower than what this looks like, or this looks like. If you follow technical analysis, you may have asked at one point, everybody's always showing head and shoulders patterns. Do they ever work? Well, here's an example of one that worked. Here's a shoulder, the head, and a shoulder. The neckline was broken right here, and the NASDAQ plunged. Shoulder, head, shoulder, neckline broken here, and the NASDAQ plunged. Similar theme and look here. You can argue that this is a left shoulder. This is a head, which is higher than the left shoulder, and then we've got a relatively small or narrow magnitude on the right shoulder. If we break the neckline here, and this ends up being a head and shoulders pattern, it would tell us the probability of bad things happening would increase. Also, we do learn something. When the right shoulder is noticeably lower than the left shoulder, that speaks to low conviction. If this turns out to be a head and shoulders pattern, it tells us that the probability of declining further is higher when you get this look. This is a weak look here, momentum-wise. We can be concerned about that. Weak look momentum-wise, weakness followed, and the slope of the 50-day has rolled over, price is below the 50-day. The slope of the 50-day rolls over, price below the 50-day. Slope rolls over, price below. Cracks here, they're either going to widen, and nothing says that they can't be repaired. We'll keep an open mind, especially with a 200-day that still looks like this. We said the major indices have to break down before too many bad things can happen. Well, we really don't have too many breakdowns here in industrial stocks. Price above the 50-day, and for the most part, it has a positive slope. 200-day with a positive slope. We'll begin checking bearish boxes if we morph into something more like this. We covered this chart a few weeks back, so we'll move quickly here. This is a monthly chart of the S&P 500. You can see we get the bearish moving average crossover. Look how helpful that is during the bear market. Bullish cross, extremely helpful. Bearish cross, extraordinarily helpful. But our purpose here is momentum. You can see when momentum starts to slow and the blue bars start to drop, the probability after they start to drop of bad things happening increase. They drop, correction multi-month. They start to drop, peaking process in a bear market. They start to drop, we get a sharp correction. They start to roll over, weakness follows. We have bars that have a concerning look. If you're a bull, you want it to look more like this. Again, if you're a client and you're wondering why we still have exposure to stocks, well, the general stock market just does not look that bad yet. Price above the 50-day moving average. Price above a bullish sloping 200-day. This tells us that the intermediate term trend for the most part is healthy but indecisive with the flat slope. The long-term trend really has not experienced much in the way of damage yet. Bearish boxes start to get checked if this morphs into something like this, where weakness followed. Weekends are a good time to make some longer-term decisions. Just a gentle reminder of how cruel bear markets can be. The S&P 500 dropped from 1576 to 666 was the intraday low. That's a 58% loss. If you have a plan and you feel that bear markets are fairly easy to spot, you might want to run your plan through this article. Google this title here, and you can find it either on Short Takes or on Seeking Alpha. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.